What is market risk? Why does the value of your investment suddenly fall, even when nothing has changed in the company? Why do banks worry when interest rates increase? Why do currencies move so sharply after economic announcements? The answer lies in market risk. Market risk affects investors, banks, financial institutions, and even ordinary individuals. It does not depend on one borrower failing. It depends on movements in the financial markets. And sometimes, those movements can be sudden and severe. Let us understand what market risk really means. In simple language, market risk is the possibility of financial loss due to movements in market prices. These movements can include changes in interest rates, stock prices, exchange rates, commodity prices. For example, if you hold shares and the stock market falls, you face market risk. If a bank holds government bonds and interest rates rise, bond prices fall. That is market risk. If a company exports goods and the currency appreciates unexpectedly, profits may decline. That is also market risk. Market risk arises not because someone defaults, but because market conditions change, and markets change constantly. Market risk can be divided into several categories. First, interest rate risk. When interest rates rise, bond prices fall. Banks and financial institutions holding large bond portfolios are affected. Second, equity risk. Stock price volatility affects investors and companies with equity exposure. Third, currency risk. Exchange rate fluctuations impact importers, exporters, and multinational companies. Fourth, commodity risk. Companies dependent on oil, metals, or agricultural products face price volatility risk. These risks may operate independently, but often they interact. For example, rising interest rates may impact equity markets and currency movements simultaneously. Market risk is interconnected. Let us take a practical example. Suppose a bank invests heavily in long-term government bonds. At the time of purchase, interest rates are low. Later, central banks increase interest rates to control inflation. As rates rise, bond prices fall. Even though the government is creditworthy, the market value of the bonds declines. If the bank needs to sell those bonds urgently, it may book losses. This is not credit risk. This is market risk. The borrower did not default. The market moved, and that movement affected valuation. Market risk therefore impacts asset values, sometimes rapidly. Market risk is dangerous for three reasons. First, it is volatile. Prices can move sharply within hours. Second, it is often influenced by external factors, economic data, geopolitical events, policy announcements. Third, it can create systemic stress. If many institutions hold similar assets, price declines can affect multiple balance sheets simultaneously. During periods of high volatility, panic selling can amplify losses. Market risk does not always lead to permanent loss, but short-term shocks can impact capital, profitability, and investor confidence. That is why financial institutions monitor market exposure daily. So how do institutions manage market risk? First, diversification. Spreading investments across asset classes reduces concentration. Second, hedging. Using derivatives to offset potential losses. Third, setting exposure limits. Institutions define how much market volatility they are willing to tolerate. Fourth, stress testing. Simulating extreme scenarios to understand potential impact. Market risk cannot be eliminated, but it can be measured, monitored, and controlled. Here is the key insight. Market risk is the price of participation in financial markets. If you invest, you accept volatility. The objective is not to avoid movement. It is to manage exposure intelligently. Because in finance, stability does not come from avoiding risk. It comes from understanding it.